Welcome to another episode of the Canadian Money Roadmap podcast. And today we are going to our second episode in our retirement roadmap series, and we're going to be focusing on the foundational elements that you need to have in your plan before you can move on to anything else. Last week, we talked about getting organized and getting all your ducks in a row so you know where you stand today financially. Today, we're going to go with the next step further and talk about the big things that are going to move the needle on a go-forward basis and focus on the big steps that you can take to set the groundwork for a secure retirement. First, let me tell you a quick story about a real-world scenario that's a perfect metaphor for what we're trying to do here with building a proper financial foundation. This is about a literal foundation for a condo building in San Francisco, and this building is called the Millennium Tower. This is right now. This isn't back in the 1800s or anything like that. This is happening right now. And when they first started building this or proposing it, it was supposed to be one of the most luxurious high-end condos that they have in the city, multi-million-dollar suites, that kind of thing. But now we've kind of realized that there's one major problem with this building, and that's the foundation. So apparently they decided to use what's called a matte foundation. I'm not an engineer. Don't yell at me if this is this is incorrect, but what I've heard anyways is that there's a type of foundation that wasn't specifically designed to work with the soil in San Francisco and the seismic activity. They're pretty well right on a fault line there. And so they didn't drill down deep enough into the ground and didn't connect the piles to bedrock. And so this thing is kind of moving and grooving a little bit. And yes, it actually has started to sink in downtown San Francisco. So I've seen a bunch of different numbers, but the lower of the figures that I've seen is that it sank more than 17 inches in one corner and is kind of tilting to one side. And so homeowners, they've had crazy situations where windows are blowing out on them because there's too much pressure on the one side. And yeah, this is a big problem. And so, of course, there's plenty of lawsuits. Welcome to the United States. There's plenty of lawsuits in this regard. And engineers have been all over this trying to solve the problem. And believe it or not, building a foundation after the building is built is incredibly difficult and very expensive. And there's been a number of solutions proposed. I think they've tried a few of them. To be honest, I'm not sure where things are at right now, but I suspect that there's not going to be a good as new type of situation for this building. So just like the Millennium Tower, your financial foundation needs to be solid. So one of the steps that they skipped with the Millennium Tower is that they didn't drill their piles into bedrock. And contrast that with a building like the Burj Khalifa in Dubai, which is the tallest building in the world. Apparently they have hundreds and hundreds of these things that go down over 160 feet into the ground, into the bedrock, because this is a building that's built on sand. So you got to commit and you got to go all the way down and connect this building to something that's a little bit more solid than that. And in San Francisco, the developers there, they clearly tried to cheap out and not spend enough money to make sure that this thing was solid enough. And this is kind of like trying to build a financial plan without spending the time and effort and, in some cases, money to get things in the right position first before you build on top of those foundational items. You don't want to have any financial disasters, and inevitably there are going to be times that are not expected and going to be financially difficult. You know, your earthquakes and hurricanes of your personal life, they're going to happen and they're going to look different for every person. But in this episode, we're going to go through some of those things that you can have in place first to make sure that you're protected. Okay, let's get started with the first step, and that is cash flow. So that's just money coming in. And this is really foundational because you actually need to have some extra cash in the bank account or just at your disposal so that you can do something with it. If you don't have enough money coming in to cover more than just your bare bones expenses, it's going to be really tough to save. It's going to be tough to get insurance, all these different things. And so the first step is just making sure that you have some sort of financial margin in your life. And I unfortunately have to be very clear here that there's no magic formula that I'm going to tell you that'll come up with some extra cash flow every month. To create margin in your financial life, you need to do one of two things. You need to make more or spend less, or a combination of the two. So maybe that's three things, but it's one of those things that it's simple, but it's not always easy. It's one of those things to have somebody to sit on a podcast and say, well, just make more money. It's like, yeah, it's ridiculous, but at the same time, if you don't have enough money coming in to cover more than just your basic expenses, it's going to be really tough to get ahead. Plain and simple. So you can only cut expenses so much before you have to make more on the other end. And so that's why it's kind of two ends of the scale. Sometimes people make a lot of money and they just spend too much of it. And so that's a little bit easier to just cut some of the expenses on the other end. But, so this stage might take some time if you don't have some of that margin. And so maybe that means you have to pick up a little bit of extra work. Maybe you can negotiate a raise at your current job. Maybe you can do a side hustle. And I really want to be careful with the idea of side hustles. And I should do a podcast about this in particular, because there's so many things like multi-level marketing companies. Major skeptics would call them pyramid schemes. But, these are types of things where you have to pay money to become a sales rep, and you have to buy all your own products. And there's so many different things about MLMs that really get people in trouble. Side hustle would maybe be freelancing some other skills that you have. I know some teachers that build fences in summer once in a while. They'll build a couple here and there, and then they use that money for their vacations or something like that. There's lots of things that are just good, honest work that I would classify as a side hustle. It's not going to be some like scammy internet thing or sales job that doesn't actually pay you anything. So if you're going to do extra work or a side hustle or something like that, make sure it's legit and actually pays you money for the work that you do. So at this stage, you don't need to worry about investing. This is just getting a little bit of extra margin, and then you can set aside that money in a separate savings account. Call it an emergency fund, call it your rainy day fund, call it your what am I going to do next fund, whatever. But if you have a couple of $1,000s there as a little bit of a buffer, that can be something that really takes the pressure off when those curveballs inevitably get thrown your way. So if you don't have any cash on hand right now, build that margin and then start saving it somewhere else. I recommend doing that outside of your checking account or even your savings account at your current bank. I keep accounts at two different banks. It's an out of sight, out of mind thing in a good way, where my savings are just somewhere else where I don't see it all the time. And then if I need to access those, then I can. But once you've kind of built this margin and then set aside some cash, that margin can then be used to do other things for you financially to build your foundation. The next thing on our list, so that was number one. Do you have enough money to save anything? Do you have cash flow margin every month? Number two, do you have disability insurance? I don't talk about this one often enough, I don't think. But think about this for a second. What would happen to you if you couldn't work for a period of time, or maybe even a long time? Many people overlook disability insurance, but it's one of those critical protections you can have in the insurance world. We call it a living benefit because you can still claim on this insurance while you're still alive, unlike life insurance, and I'm going to get to that one. If you're lucky enough to have some benefits at work, that's great. Many people do have some. Most people don't have enough, though. So I would highly recommend that you look into the amount of coverage that you can get for disability insurance at work. In some cases, you might have to do like a health questionnaire to get some more coverage or something like that. But that can often be a really, really good type of disability insurance to have. You can't have insurance through work and own your own personal policy. So think of a situation, you make $5,000 a month, but you have disability insurance that covers, say, $3,000 a month at work, and then you buy another policy that covers you for another $3,000 separately. There are rules how these insurances kind of all work together. So in that case, theoretically, you could be on disability and you could be making more money on disability than you would if you were working. No, it's that would be fraudulent in a number of different ways, but you just wouldn't be able to buy that much coverage. And that wouldn't make sense to do that because you wouldn't be able to claim that much, and your insurer might take you to court if they think you are. So disability insurance will cover a portion of your working income, and it is a tax-free benefit because you pay the premiums with after-tax dollars. And then when you receive the benefit, it is tax-free. So there's often a pretty major reduction in a relative basis compared to how much you make that you can get as far as disability insurance goes, because it accounts for some of the taxes that you're not paying as the recipient of that money. There are many variables for disability insurance. that you should keep in mind. One is called the elimination period. So that's how, or sometimes better term for it is called the waiting period. Waiting period is how long you have to be disabled before you can actually make a claim. So this would be long-term disability. And so say you get in a really serious accident and your waiting period is 90 days. You wouldn't be able to get a payment from your disability policy until after that 90-day period. You'll have to go through some paperwork and apply for it and that kind of thing. But then you can start getting paid after that period is done. Then you have the period of time that your payments will continue. In some cases, it might just be 2 years. In some cases, it could be up to age 65. Tons of room in between there as well. And so it's definitely worth looking into your disability insurance to make sure that you have enough. If you are self-employed and you do not have disability insurance, you definitely need to do this first. It is expensive because the odds are stacked against you. Some version of disability is unfortunately quite likely for many people. Many people think of disability as like completely like bedridden and you're no longer able, you're like quadriplegic type disabled. It's like, no, in many cases, it's things like carpal tunnel or a bad back. These are types of things where you're not able to do your job anymore. So if you are self-employed, definitely speak with an insurance agent to come up with some disability insurance options that are good for you and your employment situation. So this step protects you and your ability to earn an income with your own work, with your body or your mind or whatever. And so if one of those situations or your ability to traditionally earn income is taken away by health or accident, then you are able to get some money coming in from this insurance that you bought. So this protects you and your income in case something were to happen to your ability to earn it in a traditional way. Okay, step number 3, this is life insurance. Now, if you have a family, if you have a spouse, if you have kids, if you have parents that rely on you for your income, if you are now gone, if you pass away, life insurance is bad name. It should be called death insurance, but that's negative marketing there, but it's more clear of what it's for. Life insurance kicks in if you die. Okay, we're not going to beat around the bush here. Buying life insurance, this isn't about retirement at this point, because I know this is your retirement roadmap, but this is about protecting your family. And, if you were able to work until your own retirement, you've probably saved enough for your family. However, if you pass away before your typical life expectancy, you don't have the time to be able to save for retirement. You don't have the time to pay off your debt. You don't have the time to save for your kids' education. And so this is where life insurance can step in and again provide a tax-free benefit to your loved ones after you pass away. So a lot of people have life insurance through their work, kind of like disability insurance, but oftentimes it's only up to about 2 times salary. And so, maybe that sounds like a lot, but you think about what would happen if you weren't there. Would that be enough to cover your mortgage? So say you're married and you have a couple of kids. If you died tomorrow, would your spouse be able to continue making the same payments on the mortgage and stay in the house and live a very similar lifestyle if you're not around? I'm going to say probably not. And so being able to pay off a mortgage, or at least the bulk of it, with some life insurance payments can take that pressure off your spouse and your family so that they can stay in the house after you've passed away, and they're not going to be forced to sell the family home and go back to work and put the kids in daycare. Just think of these nightmare scenarios. Like, this is just brutal. So having enough insurance to cover any of your debts. Maybe you want to fund your kids' education. All of this money adds up, and it's going to be a lot more than 2 times your salary, unless you're really close to retirement, I guess. But a proper life insurance plan can really take a lot of that pressure off a real nightmare scenario of you, or maybe this is for your spouse, but it can really step in and really make a difference and make things easier financially if you or someone in your family were to pass away. Brief intro to how life insurance works. There's 2 main types. There's term and permanent. Think of term as something that is fixed for a period of time, and then after that it changes. So say 10-year term is a very common type of insurance. It's the cheapest type of life insurance that you can buy. And your coverage amount will be the same for 10 years. Your payments, we call them your premiums, that's how much you pay for it, is flat for 10 years. And then after the 10 years, most term insurance policies are something what we call renewable and convertible. Renewable means that the insurance company knows you're 10 years older and 10 years sicker. And so they're like, okay, well, if you want insurance for another 10 years, we're going to charge you accordingly. And so it's like straight line, big leap up for the next 10 years. And then after that, it's like, oh, okay, now you're another 10 years older, 10 years sicker. You don't have to tell us. We just assume. And then it jumps up again and it jumps up again. And so term insurance can become very, very expensive later on. And that's why there are longer terms. So you can get 20-year term, you can get 30-year term. Oftentimes pairing your term duration with things like your financial obligations, so your mortgage and how long your kids are probably going to be at home, those kind of things, that makes good sense. So if you have a 25-year mortgage and your kids are, maybe you've got infants at home, maybe you plan to have more kids, maybe getting some 30-year insurance, and maybe even combination, right? You can do some 10, some 20, some 30, whatever. Talk to an insurance agent. You can find a really good strategy to make sure that it's affordable today and into the future as well. Permanent insurance is not something I'm going to get into today. It has a place. It's often oversold. If you anticipate having like major tax bills upon your death, and if you want a way to give your kids some money to help pay for the tax bill on the family cottage after you pass away, things like this, they're a little bit more niche scenarios, really specific to one situation. Permanent insurance can be a great option for that. And the sooner you buy permanent insurance to cover that need, the more likely it is you're going to qualify for it, because insurance is based on your age, sex, and your health. And your health typically doesn't improve over time. And so it can be harder to get insurance later on in life if you put that off too long. But back to term insurance, the other part of that where I said it was renewable and convertible. If you have enough term insurance now, at some point in the future, you can convert some of your term into permanent if you like. So if your life is in a situation where you had temporary needs and now you're kind of planning for the long term, you don't have to cancel your policy. You can convert it to a type of permanent insurance if you like. And then at that point, your premiums will go up, but they'll stay flat at that higher price, and you'll pay them for the rest of your life or until you turn 100 typically. I shouldn't get into that too specifically because there's a number of products where you wouldn't necessarily pay for it your whole life, but that's kind of how you can use term insurance today and kind of decide on the optimum product later. So it would be better to get enough cheap term coverage today and then change it to a different product maybe later on if the insurance company that you work with offers such a thing. Most of them do though. So life insurance. So this, again, it doesn't get you to retirement. It doesn't protect your income for you per se, but if you love your family, you're going to buy life insurance. That's kind of the straight goods on that one. It's not expensive, especially if you're in good health and you're reasonably young. You can get term insurance for really cheap. Think $100 a month or less for a meaningful policy for the average Canadian. In many cases, quite a bit under. I just did a quote for someone who's in their mid-30s for $1 million of coverage, and it was going to cost them, I think it was about $45 a month. So just so you have a kind of a frame of reference for how much term insurance can cost. This isn't thousands and thousands of dollars that you have to be throwing away every month on something that we hope you never have to use. But it has a major impact and you need to have it if you have someone that relies on your income. Okay, number 4, this is kind of in the same vein and even fewer people have this. Do you have a will? And a will is the document and the instructions that says what should happen with your stuff, including your money, after you pass away. And yeah, no one thinks that they're going to die young, but the unfortunate reality is that sometimes that happens. And so having a will is not for old people. Having a will is for people who are married. If you have kids, if you own a house, if you have assets of any kind, you should have a will. Because if you die without one, Government's not going to come take your stuff, but they're going to be the ones who decides who gets everything. And the process can be a nightmare for your family. It is not straightforward as to how everything works. Every province is different. I'm not going to give legal advice on this podcast by any means, but it can be a situation where it will not go to the people that you want it to. And this can create a real headache. So, staggering statistic here from the National Institute on Aging, only 48% of Canadians have a will. That is not good. That's not good at all. That is a disaster. So you need to get a will. If you are within the sound of my voice, you need to get a will. Talk to a lawyer and get it done right. There are some services online that can offer will services, and I think they're getting a lot better. I haven't vetted any of them personally, so I'm not going to vouch for any of them. I would probably just default to speaking to a lawyer about this, because when I did my will, for example, a number of years ago, a lot of things came up in that process that I never would have thought about. And it was really, really great to speak to a professional who deals with those kind of things, because not only did I not think of all the different scenarios that could come up, I don't know the impact of them and what the rules and the laws are around how to deal with those kind of things. And even a little bit more like lighthearted things, like if we were to pass away, what happened with our dog? We don't have the dog anymore, unfortunately, but if we had a dog, like, okay, who takes care of this little guy, and do we want to set aside money for that person to be able to do that? And now we have kids, and obviously the conversations get much more difficult if you pass away and your kids are left with a family member. And in your will, you can decide which family member watches your kids. Make sure you tell them about this so they're not surprised. But anyways, again, this is a situation where if you love your family, you will have a will. If you want to make their life difficult, you will not get a will. That's kind of how this is. It's harsh, but that's life. And it's something that's very easy to avoid, because there's no one beating your door down to get a will, and you only realize the impact of it when you're gone and you don't have to deal with it yourself. And so it's very easy to just say, that's later me's problem. But again, if you have a family, if you have any assets at all, get a will. If you're going to be a financially responsible person, get a will. Okay, that's it. Number 5 is the last thing on my recommended list for a foundational item that you should take care of first before doing anything else in regards to planning for your retirement. This is dealing with any high interest debt. So a lot of people will say focus on paying off debt first as just like a primary financial activity. But I would recommend dealing with the insurance in your will first. Why? Well, because the risk of death or disability does not change because you have debt. Like, they're independent of each other. And you're not more or less likely to die because of your debt burden. But the financial impact of a death or disability can be much higher than just the debt alone. So I definitely recommend that you get all of those things in order first. Again, you have to have the cash flow in place to be able to afford the insurances and getting a will. And then once you have those things in place, then let's hammer away at the debt, and especially high interest debt like credit cards. Okay, I can't tell you how many people I've talked to that carry a balance on their credit card month after month. And carrying a balance on their credit card, if this is jargon to you, all that means is if you use your credit card to buy things, there is a balance that accrues based on how much you've used the credit card. At the end of the month, or whenever your statement shows up, if there is a number there, that means you have not paid it off yet. You need to pay that off every single time, in full, every single time, or else you are paying an outrageous amount of interest. And in that case, interest is throwaway money. Part of being a financially responsible person is minimizing how much throwaway money you have. Some people prioritize different things, like buying nice things or buying expensive food or whatever. I don't see that as throwaway money. Throwaway money is stuff that you get zero return on. And so, paying credit card interest is throwaway money entirely. So if we can minimize that, you'll be in much better shape. I talked to somebody last week that didn't know that interest would start accruing if you didn't pay off their bill in full. And they were paying minimums or maybe a little bit more than the minimum because they thought that was how you did it. And no, we set up a system, and we actually came up with a really slick system. I said, okay, at the end of the month or whenever this person got paid, on that day, regardless of what statement came out, you log into your online banking, you look at your credit card balance, whatever that number is, you transfer that from your checking account right there every single time on that day, every month, and you'll be in good shape. Don't worry about statements, whatever. You need to do it every month, at least every month, and you pay it off in full. If there is a number there, it needs to be a 0. Okay, so credit cards are a big one. And in some cases, I've seen emergencies, and yeah, emergencies happen where, say, they needed to put $10,000 onto a credit card and they don't have 10 grand on hand to pay it off, but they have access to, say, a home equity line of credit. And this is access to debt that's tied to your house. And so because it's tied to your house, the bank is willing to give it to you for a whole lot cheaper than your credit card. So like a home equity line of credit right now might be like 7.5%, and a typical credit card is like 20%. If this is a situation where you find yourself in and you're not paying off your credit card, borrow money from your home equity line of credit and pay off your credit card. This is a rob Peter to pay Paul and save yourself 14% in between. It's, yeah, definitely something that you need to do. And that way, just on the interest alone that you can save every month, you can have enough additional cash flow to pay off the debt sooner, right? So by putting your high interest debt onto a line of credit that's lower interest debt, you can much more quickly tackle that debt on a go-forward basis. If you're in a situation where credit cards are a problem for you, you should probably just get rid of them, or just ask to have your credit limit reduced. That can be a good way to keep yourself from spending too much if that becomes a problem for you. But getting rid of high interest debt is critical because, if you're paying 20% interest on credit card debt and you're wanting to invest in stocks in your RSP, your expected return on that is going to be in that ballpark of like probably 7% or less. 7% versus 20%. This is something that you really need to tackle first to best use your money. I won't hammer that one too much more here, but let's just recap the foundations of a solid financial plan to get started. So number one, cash flow. Make sure you have enough income and a little bit of margin every month to save regularly. Maybe it's not even every month. Sometimes people have irregular expenses, whatever, every quarter, every year. If you end up with a little bit of money at the end, that's great. But you need to have that before you can really do much else. Yeah. And that can be hard. And maybe that takes the longest out of all of these to get there. But that's one of the things that you need to have in place, a little bit extra cash. 2, disability insurance. This protects your income in case you're unable to work. And number 3 is life insurance. This protects your loved ones in case something happens to you. Vice versa, if you have a spouse, make sure that you're protected too if you rely on them for their income, right? Make sure both of you have enough coverage if the whole family is relying on 2 sources of income. Same thing with disability insurance, of course. And number 4 is get a will. Make sure your estate, that's whatever's left behind after you pass away, make sure your estate is handled the way that you want it to be. And debt, as the last one, is knock out that high interest debt as soon as you can. So once you've got these basics kind of covered off, you'll be ready to move on to the next step on your retirement journey, which is investing for your future self. So that's what we're going to be talking about in the next episode. So stay tuned for that. Thanks so much for watching and listening to the podcast. If you're listening on audio only, you can head over to YouTube and you can watch this there. A little bit different. Some people like to watch on YouTube. Some people like to listen in the car, whatever. It's all good. I try to be wherever you are. I appreciate you listening or watching wherever you do so. Thanks so much, and we'll see you again.